Today is Monday 15th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Steve, what did the USDA say about the world supply and demand of grain last week?
For 2017 and 18, they basically said that there's going to be still record supply ending stocks for both wheat and soybeans, and they brought down the corn stocks, mostly because of China. Market reaction was basically, okay, we're going to stay in these trading ranges until we know more about the summer U.S. and Northern Hemisphere weather. Looking ahead, I think that some people feel that the soybean demand might be just a little bit less than what the USDA says, and that could raise the carryouts. Corn's all up to yield, and the wheat, right now we have too much.
As you said, the primary factor right now in the grain markets is weather. Can you give the viewers an update as to the current conditions in the central growing regions here in the U.S.?
Well, it's almost like weather by request, because the east has been too wet, and now it's going to be dry not only over the weekend, but dry through most of this week, which will allow for a lot of plantings to catch up. During that time, it's going to be raining in the west, where they've got most of the crops planted. So right now the conditions are favorable, and for at least wheat and corn, it's offering resistance to the marketplace. The extended outlook for 2 weeks, though, is wet for much of the Midwest.
Trading volume has dropped a bit, and it looks like prices are still stuck in that current trading range. What will we need to see for these markets to break out of these current ranges?
Whether you're a farmer or a speculator or a commercial grain trader, you know that there's only one thing, and that's weather. So it's going to take us a while to get through the rest of May and maybe into June before we can put a tag on what the weather's going to be like this summer, both here and across the rest of the Northern Hemisphere. Without a weather problem, prices probably will just sink lower into the fall.
Steve, here's a market we don't talk about all too often, the cotton market. The cotton market up an expanded daily limit today. What's going on in that market?
It was interesting because when the USDA came out with their projections for 17-18 U.S. supply and demand, it was bearish, and the initial reaction was negative. The next day, once the selling had subsided, speculators came in and bought it. Maybe it's because of the rain slowing the cotton planting for the rest of this crop year here in the United States. Maybe it's because of all these China deals that are being worked out, and they may actually buy more cotton. But as one broker said, once the selling had subsided, all hell broke loose, and just people came in and started buying it.
Finally, Steve, what should the farmer be looking to do right now in regard to forward sales? Should our brokers be encouraging selling or at least some type of hedge strategy right now?
Farmers here and in South America are frozen because for the most part, especially in the corn market, prices are below break even. So right now, in a trading range, there's not much you can do. You know, we got to wait to see if it breaks out on the upside or on the downside. If you don't have a lot of expenses, you can sell forward some corn, especially if you get December around $4, and then replace it with a call. For the beans, everybody's negative beans, just is too much of it. So people are trying to buy some puts to protect against the downside in this fall. Not much to do in the wheat market. It's too cheap to sell, but it doesn't look like it's going to rally too much.
Alan, let's shift a little bit and look at the financials. Late last week, the producer price index numbers came out higher than expected, excluding food and energy as well. What's your take on this report?
Well, it does appear that inflation is with us. I think it's here to stay. In fact, we turned the corner from global deflation to global inflation in the last part of 2015. So even now we are starting to see a reaction in the precious metals, both gold and silver, breaking some very steep downtrend lines late last week with good gains today. So inflation is going to be with us for a very long time. I think it's going to be a multi-year situation, and I think the prime beneficiaries will be the precious metals, both gold and silver. So continue to trade this market from the long side. even though we did see some long liquidation with flight to quality longs being liquidated over the last month or so, but I think that is past us now, and inflation, I think, is going to be the focus to drive the precious metals higher.
Let's talk about the dollar. Why has the dollar been so weak despite the FOMC being on track to increase its Fed fund rate in June? Wouldn't this normally be considered to be bullish for the greenback?
Normally it would be, and it has been. In fact, it was last year when the Fed was the only central bank that was on course to raise rates while other central banks were basically in an accommodation mode. But that's all changed now. So the Fed is still likely to raise rates 1 or 2 more times this year. But the European Central Bank is likely to start backing away from its easy money rhetoric later this year. And even the Bank of England will probably raise rates in 2019. So the interest rate differential advantage that the dollar has enjoyed all of last year is gone now. So we would expect the dollar index to work lower. And in fact, I think within the next month or so, we could take out these 6-month lows in the US dollar index.
So interest rate increases from the Fed are usually associated with lower prices for stock index futures. Why did the S&P 500 and NASDAQ futures advance to new historical highs last week when the FOMC is tightening credit conditions?
Well, even the NASDAQ again today making a new a record high as some of the indices did last week. So as Steve said about with grains being weather, in the financial markets and in the stock index futures, it's interest rates. They're still low enough to sustain the bull market in stock index futures, even with 1 or 2 more rate increases. So it's the interest rate influence that will dominate and has dominated all others. So we continue to be bullish on the indices. I would expect continued gains all of this year across the board in all of the major stock index futures. And any breaks should be used as buying opportunities.
So how about a trading tip for our viewers, Alan? What opportunities should traders be looking for right now? Should they be looking for pullbacks to buy into the metals? Should they be looking for good places to continue to get long the stock indexes?
I like the stock indices on minor breaks, any type of small break in the indices, any type of small break in the gold and silver. And in fact, the 12.15 to 12.20 area held extremely well in the gold futures. So a $5 to $8 break in gold should be used as an opportunity to get long. And a 15 or 20 cent break into silver also should be used as a buying opportunity.
Okay, remember the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.